Housing just sent a message that lower rates could not fix. January existing home sales did not just soften, they fell sharply, and that drop is happening at the same time payroll revisions are quietly rewriting the labor story. When housing and labor weaken together, markets usually realize it late. Our strategy does not begin with narratives, we begin with mechanisms. Housing is not a confidence survey, it is a long-duration cash flow commitment. Buyers take on obligations that last decades, and those commitments depend more on income stability than on whether mortgage rates fall a few tenths of a percent. If income visibility weakens, demand stalls even when borrowing costs drift lower. That is exactly what we are observing. December sales were revised lower. The recovery never meaningfully took hold, and that tells us affordability may not be the binding constraint. Stability is. Payroll benchmark revisions show that job growth was materially weaker than initially reported. When we compare employment growth to population and long-run trend requirements, the labor market appears to be falling short. That shortfall acts like a hidden tightening. Consumers may not describe it in macro language, but they feel it through slower hiring, reduced hours, and weaker job mobility. Housing then becomes the transmission channel. Volume slows first, prices respond later, credit follows after that. If you find this kind of sequencing helpful, consider subscribing. We focus on signal progression across labor, credit, liquidity, and rates so you can understand how risk evolves before it becomes obvious in price. Within our strategy framework, this most closely resembles late Phase 1 pressure drifting toward Phase 2 multiple compression. Phase 1 is melt up with cracks. Phase 2 is rotation and valuation compression without necessarily a collapse. Based on current signals, we assign roughly 65% probability that late Phase 1 fragility persists into mid-2026. We assign approximately 25% probability that Phase 2 becomes dominant by late summer 2026, especially if credit spreads widen and unemployment trends higher. A lower probability near 10% remains for re-acceleration if hiring stabilizes and transaction volume rebounds meaningfully. This analysis is educational and not investment advice. What confirms escalation is straightforward. Rising continuing claims, widening high-yield spreads, sustained bull steepening in the yield curve, and further housing volume deterioration would increase Phase 2 probability. What invalidates this view would be stabilizing payroll revisions, improving hiring rates, steady credit conditions, and a clear rebound in transactions. The distinction is not whether this is 2008. It is not. The distinction is whether labor underperformance remains persistent enough to restrain demand across multiple sectors. Housing weakness tied to employment gaps explains lower yields, cautious equities, and fragile sentiment within one coherent transmission framework. The next signal to watch is whether labor stabilizes before credit absorbs the strain.